Today we're going to talk about taxes, specifically for online entrepreneurs, like all of you are. We're going to talk about the types of taxes, the civil versus tax concept of residency, they often get confused. The LLC grey area, a few of you may have a US company or are thinking about starting one, we'll see the pros and cons of that. Why it's harder to hide your money and how you can still do it. And FAQs at the end, so like crypto, Wise, Revolut, national insurance, all of this stuff that you might have questions on. So this session is going to be quite interactive because if I speak about taxes for an hour, you're all going to fall asleep. I've prepared a little game. I've got here favorite food, protein balls, and we're going to go over the type of taxes, and I'm looking for 4 types of taxes. I want you to tell me what the name of the tax is, who pays that tax, and who decides the rate. And I've got protein balls for you. All right. So, you tell me, raise your hand, and just tell me a type of tax that you know of.
Personal income tax.
Personal income tax. Yeah. Who pays it?
Me.
Yeah. What are you?
A person.
People? Say physical persons, but humans, yeah. And who decides the rate of income tax that you pay?
I think I get the question. The government tax brackets, whatever.
Yeah. What government? What decides?
Sweden currently for me.
Why Sweden?
Because I'm resident of Sweden.
So the country of your tax residency, right? Tax residency. So income tax is what you pay personally on your own income, right? That's 2 protein balls for you. Next one, we've got 3 more. Go for it. Corporation tax. Who pays that? Do you pay corporation tax? Who pays corporation tax? Yeah, in particular companies, right? Or corporations. And as we'll see, this is different from a person. And who decides the rate? What country? Country where the company is set up, right? That's it. There you go. Right, I'm looking for 2 more. We're going to be focusing on these 2 for today's session, but looking for 2 more.
National insurance.
National insurance, yes, but we're not looking for that. We're looking for the main types of taxes. Give an example. Any of you into crypto, stocks?
Capital gain taxes?
Capital gains. Who pays it?
I do.
So persons, anyone else?
It could be your business if your business is the one investing.
Yeah, both. Companies and physical persons. So capital gains tax is when you buy something and then you sell it at a profit. So let's say you buy Tesla at 20, you sell it at 40, you made a profit of 20 bucks, right? And on that 20 bucks you pay capital gains tax. Everyone pays capital gains tax, whoever makes the gain. And who decides the rate?
I guess it's the country you're resident in.
If it's a person. If it's a company?
Then where the business is set up.
There you go.
Again?
Yeah, so the place of tax residency, and this can be either personal or the place where the business is set up. That's 2 other protein balls.
Don't touch my protein ball.
Final one. Go ahead.
Inheritance tax?
Yes, we're not going to cover that today. But yeah, when you die, you have to pay taxes on the money you inherit. It's the one that most of you actually pay every day. Sorry?
VAT?
VAT, yes, sales tax in particular. So VAT is a type of sales tax. It's a UK type of sales tax. Who pays sales tax?
Businesses.
Everyone, right? Everyone who pays something, right? Go to a restaurant, you've got VAT on it, right? You buy a service, usually you've got VAT on it, yeah? So again, both, whoever buys the service. And who decides the rate?
The country that you're buying the thing in.
in particular, it's the country where the service is delivered, right? So if you go into a Thai restaurant, Thailand's going to have Thai VAT. If you're buying a service in the UK, UK is going to charge UK VAT, right? Give that to Harrison because you already have 4. How are they? Do you like them?
Yeah.
Let's go. Right, so these are the 4 main types of taxes. We've gone over them: income tax, corporation tax, capital gains tax, sales tax. But today we're going to be focusing on the top 2, income tax and corporation tax. So, income tax, we said that it depends on the place where you're a tax resident, right? It's the tax that people, physical persons pay, and it depends on your tax residency. So, when do you become a tax resident of a country? Does anyone know?
So in Sweden, for example, if you stay in Sweden for more than 183 days.
So 183 days, most countries will have 183 days as the rule, right? If you spend over 183 days in a year in a country, you're going to become a tax resident in that country. But what if you spend less than 183 days? And the answer is, it depends, right? And each country needs to be considered individually, right? So I'll give you an example. A lot of people have the either-or misconception. You may be living between the UK and Thailand, and you're like, where do I pay taxes? Do I pay taxes in England or do I pay tax in Thailand, right? And the answer is, each country has a set of rules. So for example, if the UK's laws are that if you spend 90 days, you're in the UK tax system. If you spend less than 90 days, you're not in the UK tax system. And Thailand has the same rule, but with 180 days. So if you're spending over 180 days, you're in the tax system of Thailand. If you spend less, then you're not. If you do the maths, if you spend 100 days in the UK and 200 days in Thailand, then you're a tax resident of both countries, right? But if you spend less than 90, let's say 70 in the UK and 150 in Thailand, then you're not a tax resident of either, right? So it's not which one of these am I resident of. It's like each country will have its own rules that determine whether or not you fall into their tax system, right? So, overview of some countries, solely day test. Very few countries have these tests, but basically you either spend, if you spend a certain number of days here, you pay taxes here, like Thailand. Thailand is 180 days, you're either in or you're out. The UK is not this precise. There's a series of tests, but at the end of which they're going to give you a number. And if you spend 1 day over, you're paying taxes there. If you spend 1 day under, we're not paying taxes there. We're talking about income tax here personally. And this doesn't matter if you've got a passport, if you've got property, if you've got family, this is solely day test. There's other countries, like the US, that unfortunately tax you only if you've got a passport. You can literally be outside of the US, and I've been living for 10 years outside of the US and not come back. The US will still tax you just because you've got an American passport. And then most countries actually have a very broad test. All the European countries, Canada, Australia, New Zealand, and their rules are, yes, if you spend over 183 days, you pay taxes with us. But if you don't, then we're looking at your habitual abode. Then we look at your domicile, which basically means where do you usually live, right? And here's where the concept of civil and tax residency kind of intertwine, right? Because with the days test, you can actually be resident in one country and pay tax in another country. But Sweden, for example, if you spend less than 183 days, but you're still living in Sweden, or you still have a place in Sweden, Sweden might consider you a tax resident in Sweden, right? Because say maybe you're spending only a few months a year in Sweden, you're spending a lot of months in Thailand, right? But maybe you're hopping Airbnb to Airbnb. You're on a tourist visa. Every time you get in, you do visa runs, right? Sweden may look on that and say, fine, you're not spending a lot of time here, but where else are you paying taxes, right? You're on tourist visas. You're still using the Swedish bank account, right? Your only home is, you've probably got a home back in Sweden because your parents have a place there. We think Sweden tax office might say, hey, you're not paying taxes anywhere else, you pay them with us. You've got a passport, you've got family, you've got connections. Here's where you pay taxes. So income tax. Does anyone know how you prove your usual home is in a country?
Is it like statements, utility bills and all that shit?
Not only. I was like, yes, that's a very small part of it. No, but the point is that they make it hard on purpose so that If you're making a lot of money, then they can interpret the law and go after you, right? If you're making 50K, right? If you're making like very little money, the tax office is not going to matter. You can do whatever you want. You can have a company in, Dubai, the US, you can do whatever you want. The problem is when you're making a lot of money, right? And that's when you actually need to make your case airtight, How do we make our case airtight? We've kind of gone over it before, but it's like, fine, ideally we spend 6 months in a country, right? 6 months in Thailand, you're in Thailand's tax system, like, okay, happy. But again, as I said, if you're just hopping from Airbnb to Airbnb and you're on tourist visas, then your home country, Italy, Sweden, Australia, Ireland, they might go, okay, but you still live here, you've still got a bank account here that you're using a lot, you've got a house, so they can still argue that you're actually a tax resident back home. So step number 2 would be to get a visa, right? One of these visas in Southeast Asia, like the DTV, the E33G in Indonesia, there's a digital nomad visa in Malaysia as well. And those are perfect because they literally allow you to live in that country, right? In Thailand, the DTV, I don't know who of you has it, allows you to live in Thailand for 5 years, and it allows you to work in Thailand for a remote business. So that's a lot better. Now you're staying 6 months, and now you've also got a visa that allows you to live in Thailand, right? So now your case is a bit stronger. What do we do afterwards? Ideally, we try and minimize the use of our home bank account and use a bank account in a different country, right? Ideally, we don't own anything in our name in our home country. If we have a house, ideally, it's rented out, right? And again, it's about making the case as strong as possible. So when you're actually making a lot of money, 500,000, 1 million, that's when you actually want to look at renting out a house, right? Renting out a place. Even if you're not staying a long time, that's when you want to rent out a house here. So now your case is, okay, I've got a visa that allows me to stay here. I'm spending 6 months a year here. I've got a house. Here are my utility bills. Here are my bank statements that I've been on 7-Eleven for the past 6 months, right, in Thailand. So that's when the case becomes really strong. So again, these are the main cases. And to be fair, once you've actually got a property, like a rental agreement for 12 months put down, you don't even need to stay 6 months in a country anymore. I don't know who of you follows Formula One, but most of their drivers, do you know where they have their tax residency? The Formula One drivers. In Monaco, right? That tiny piece of land between Italy and France, right? Or in France. And they don't spend 6 months a year in Monaco, right? Because they're traveling around every week to a different country to do Grand Prix. But the way they prove it is they have a residency permit in Monaco, they've got a bank account in Monaco, and most importantly, they've got a house there, right, that they either own or they rent out for 12 months a year, right? So that's how they prove it. So once you've got a house, once you're making, let's say, 1 million, 500,000, 1 million, that's when you rent out a place, and now that's your only home. Assuming you don't have houses anywhere else in your name, that now becomes your house. And then even if you're spending like 2 months a year in that house, for the rest of the time, you can say you're out for work, or like the Formula One drivers, or just for holiday, right? So, fine. Let's say in the UK, if you spend over 90 days, you're a tax resident, right? In Thailand, 180 days. In Australia, Sweden, if they consider that your usual home and you've got enough ties, you're a tax resident there. But what do they actually tax you on, right? And most of you will just assume that you're taxed on everything, because that's how all the countries operate, right? England, Sweden, US, Ireland, like every single country that I've named tax you on your worldwide income. This means that if you've got business income and you pay yourself dividends, that's taxed. These are UK rates, but every country will have different rates. They'll tax you at 39%. Capital gains, buy Tesla for 20, sell it for 40, you're taxed 24%. Crypto, if any of you has crypto, you buy Bitcoin, exact same thing, buy it at 100, sell it at 200, pay the capital gains on the difference. Rental income, if you've got properties, even if it's somewhere else, like even if you've got your tax residency in the UK, but you have a house in Spain that you're renting out, that income is still taxable in England, right? So this tax basis is called worldwide income. But there are 2 other tax bases that make it a lot more attractive, and that a few of you are exploiting to actually not pay any taxes, right? And this is how it works. So this is worldwide taxation. Everything you make is taxed wherever it is. Remittance basis is a system that you have in Thailand, in Malta. The UK used to have it. I don't know if you heard of the non-doms a few years ago. But basically the idea is that they're only taxed on the income that's brought into that country, right? So let's say in Thailand, yes, it has its rates, 0 to 35%, depending on what you make. But they only tax you on those rates, they only apply them to the income that you bring inside of Thailand, right? So if you're making money from a foreign company, right, which just means like not a Thai company, and you're bringing that money into Thailand, right, that money is taxed. If you're not, if you're keeping it outside in your home country's bank account, in an offshore bank account somewhere else, in the company's bank account, that money is not taxed. And one step further is territorial tax basis, which is countries like Malaysia, Paraguay, Panama, where you're only taxed on income made inside of the country. So as long as it's made abroad, it's not taxed. You can bring all the money you want inside the country and it's still not taxed. As long as you're not running, a Panamanian coffee shop in Panama City, or like a clothes shop in Malaysia, in KL. And this is how we're exploiting the tax system to pay no taxes, right, as online entrepreneurs. So it's 2 steps. It's, are you a tax resident there? Each country needs to be considered individually, right? Here you have been into 6 different countries. Will I fall into this, or this? And once you're resident there, what am I taxed on? Am I taxed on capital gains? Do they tax crypto? What is the percentage rate of business income? Am I taxed if I bring it in, if I take it out, if I send it to my mum, right? Yeah, that's income tax. That's sold personally. Any questions? Great. Corporation tax. Right. Corporation tax, we said, is what companies pay, right? Maybe a few of you have companies, maybe limited companies, companies in Australia. And what you need to understand is that when you set up a company, right, you are literally creating another life. It's another legal entity. It's like you're creating another person. That company now has rights, gets paid, has its own assets, its own property, its own debts. It can be sued, right? It's completely a different life, right? So income tax is what you have to pay on your personal income, and that depends on the personal tax residency. But the corporation tax is what the company has to pay on its profits, right? So to drive this home, this is the difference in the payout structure. So if you're a sole trader, like a lot of you guys, you get paid straight into your bank account, or through Stripe and then you get the payout into your personal bank account or Revolut. And that income is taxed personally. Like you are paying taxes on that. If you have a company, what happens is the company makes the profit, right? And then when you want to take out money, then you have to pay taxes again personally, right? It's quite nice because it offers limitation of liability. I'm not sure if you know what this means, but basically you can't be sued personally. Like when you fuck up through a company or the company has debt and it goes bankrupt, they can't come after you. If someone wants to sue you, they can't sue you personally and go after like your car, your house, but they can only sue the company. And if you shut down the company, then the person who's suing you is not really gonna have a lot of luck, right? So again, the payout structure, you own the company, but now the clients are paying the company, they're not paying you. Separate entity, separate person, someone else. The company's making its profits. Revenue minus cost is the profit, and then on that profit figure, you pay corporation tax. This is just an example, 25%. And now you're like, how do I take out the money? You pay yourself dividends, right? And now you pay income tax based on this factor, where you're a tax resident personally, right? So if you're in the UK, 39%, whatever, that's the payout, right? So 750, you pay yourself as dividends, you pay 39%, and you're left with basically 450 from the 1,000 that we've started, right? So I'll give you an example. Elon Musk, right, to drive this home. He owns Tesla, right? Tesla has its own revenues, it sells cars, right? It has its costs to produce the cars, for the employees, for the factories, and the difference is the profit, right? Elon Musk is not the guy who pays the profits on all of Tesla's taxes, right? On all of Tesla's profits. Tesla pays its own taxes with its own bank account, and then if he wants to take money out, then he takes out dividends, and then he has to pay taxes personally. Yeah, does that make sense? Okay, lovely stuff. Does anyone know why you can't just set up in Dubai or in the Cayman Islands? We said that the corporation tax is given by the place where you set up a company. What if I set up a company in Dubai? I mean, now it's 9%, but what if I set up a company in the Cayman Islands and pay 0, right? Why? Does anyone know why you can't do that?
Can they give that, those, like, well, your details to your home residency?
Yes, you can. We'll talk about that. But what if they do? I mean, my company is not in in my home country. I just decide to set up a company in the Cayman Islands. I don't go there, but it has no corporation tax, so can I just set up a company in the Cayman Islands? Does anyone know why you can't do it? Okay, this is a tough one. It's fine. So 2 reasons. The first one is permanent establishment, and the second one is controlled foreign company. This gets a bit complicated. I'm not going to go in too much detail, but just so you know, you can't do it because of a permanent establishment. Basically, if you have a fixed place of business in a certain country, that country can claim corporation tax on the profits of the business, right? So usually it's like if you've got an office, if you've got a factory, if you've got a shop, for example, those are fixed places of business which don't touch us as online entrepreneurs. But the problem is, here's the catch, is that one of these criteria for generating a permanent establishment is a place of management, right? And obviously, if we are the only owner, right, and we're the only owner, we control the company, we don't really have board meetings, we don't really write to investors, to shareholders, because we're the only person. Our home country can argue, if you spend a lot of time there, this is actually a place of management, right? So we are going to tax your company based on the profits generated by this fixed place of management, right? But obviously, because you don't have any employees, you don't really have any other location, the profits that are generated by that place of management, by that permanent establishment, is all the profits of your business. So basically, all the profits get diverted to your home country, and then you have to pay taxes again. CFC rules is more advanced, doesn't apply to you yet. Soon it will. It's only when you're making over $1 million in revenue. You basically can't own a company that pays, let's say, a company in a tax haven, right? If you're a resident of a country with a high tax rate, like the UK, Sweden, anywhere in Europe, anywhere in Australia, if you're a resident there, you can't just own a company in the Cayman. That's literally just the rules. You can't do it. Very well, you had a question?
Is that $1 million a month or a year?
A year.
Okay.
$1 million a year. Is that clear? It's a bit complicated, but this is why you can't just set up a company in Dubai and just not spend any time there. Yes?
So if you would set up a company in Dubai, you would also have to set up a physical place. Is that what you mean?
Yes.
And then you would be eligible to pay the Dubai taxes.
So, again, it's 2 different rates: tax residence, income tax, and corporation tax, right? And these are decided.
What about the corporate tax?
So the corporation tax. So again, not all countries have this rule, right? Or actually, most countries do, but it's hard to enforce. Like if you have a company in Dubai and you're just spending time in Thailand, like it's never happened yet, obviously. But it's never happened that Thailand says, hey, this Dubai company is actually a Thai company because you have a place of management here. It's never happened, you know. Maybe it will, but there's no infrastructure right now in Thailand to be able to do this. But if you have a company in Dubai and you just run it from Italy or Sweden or, Ireland, whatever, any country, any of the legacy countries, the Western countries, you really can't do that if you personally live there. Unless you've got other people that are part of the company. Like maybe you've got a co-owner that's in Dubai, then you can actually be in Italy, wherever, Spain.
Renting a 12-month lease not apply there?
Yeah, it would. It would. Because that then becomes your permanent residency, right? And your tax residency. Obviously, it's always grey areas, right? The more money you make, the more you need to make your case airtight and document, like you were talking about, out of office, right? All this stuff, and show that you're not actually working when you're in that country. So it's not actually a place of management. Like document where you make decisions. So create even if it's just you, create your own documents for like board meetings and shareholder meetings, and just date it and put the location that you're actually somewhere else. You're actually making the decision while you're here in Samui rather than, in Newcastle in a coffee shop making a decision. All right? Is that clear?
But that is definitely a grey area though, because I could just say someone came after me for tax, I could create like a Word document and just fake a journal.
Yeah, no, it definitely is.
But that would work then.
Well, it works if you don't get caught, right? So the thing with this stuff is it doesn't matter until they come and audit you, right? And ask you questions like, where were you 2 years ago? We think that for this year, because this is how audits happen. Like, a lot of people don't understand this, but you know, if you fuck up this year, if you do some dodgy stuff this year, like nothing's going to happen this year or next year. It's probably going to be like in 2 years, they're going to go like, hey, Simon, back in 2025, we thought that you owed taxes here. We thought that you had a permanent establishment in the UK. And now it's up to you in 2025 to show them, hey, actually, this is my visa that I was living in Thailand. This is my, you know, flights, boarding passes that I was actually in Thailand for this period. You know, these are my, these are my board minutes, right? This is the amount of time I spent in the UK. These are my contracts in the new country, right? It's about building a case, right, for yourself. And the more you're making, the more you need to be careful. Yeah? Does that make sense? Yes.
What if 3 year, like, younger yourself was like, he was supposed to pay whatever, like 2K in taxes, but he didn't know that he was supposed to do it, and then 3 years later they come back and at you because now you're making money, so they start investigating that, and then they're like, oh, you owe us taxes 3 years ago.
Yeah, that can happen.
And what happens then?
Well, they're gonna ask you, you either pay it or you go to court, right? And a lot of people go to court. Usually by the time that they're doing that, right, you're gonna have the money to go to court. Like, think about HMRC, these tax offices, they're like businesses, right? Like, HMRC is not gonna put a guy on a case if they can only get 2K in taxes back, right? It's like a business, right? They don't want to pay some guy like 10K over 4 months for an investigation if it's only going to get them 2K, right? So that's, in practice, it's never going to happen, but in theory they can. They can go back and now they say, hey, you owed 2K for this period. They usually ask for a markup, right? If they can prove that you did it on purpose, that you knew and you still evaded, it's like double the fine. But usually in taxes, everyone just plays dumb, like, oh, I didn't know it. So they just add like I think in the UK, it's a 30% markup. So if you owed 10,000, it's 13,000 that you have to pay, 10 plus 30%.
Per year or just like?
Well, for that year, right? Each year, each tax year is considered individually, right? So usually the audit is going to be for a specific year, right? Or maybe 2 years. Right, but each year is considered separately, right? So for this year, you have to pay this tax. For this year, you have to pay this tax. Does that make sense?
But if it was for a specific year and then 5 years later they come back, do you pay interest because you haven't paid them?
No. It's not interest, but it's that like fine, right? So usually, if you say that you didn't know, it'll be about 30%. Right. Who here has an LLC in the States?
Camera guy also.
Yeah, oh, 1, 2. There you go. 4 people. So, the reason why it's so nice is because it has a different payout structure to most companies that allows the exploitation of those territorial tax systems that we were talking about, right? So the Panama, Paraguay, you know, even Thailand remittance basis. And you saw this graph before. If you're a sole trader, your profits go straight to you, right? Like, whoever doesn't have an LLC or a limited company, this is what's going on. You're paying income tax personally. If you've got a company like an LTD, the profits are going to the company's paying you out, so you're paying taxes twice. The sexy thing about this company is that it's taxed in the same way as a sole trader, right? So all the money that you earn flows down straight to you, right? So the money goes to the company, but then you are liable for the profits of the company, right? Then you have to pay taxes based on where you're a tax resident personally, right? So the company doesn't pay any tax. The company doesn't pay any corporation tax, right? There's no corporation tax here, but the income tax is given by your personal tax residency, right? So if you're resident in the UK, you have to pay UK tax on the profits of the company. If you're resident in Thailand, you have to pay Thai tax on the profits of the company. If you're resident in Ireland, you have to pay Irish tax on the profits of the company. right? The big misconception is that a lot of people set up the company and they say, I don't pay any tax. It's like the company doesn't pay any tax, right? But now, the taxes of the company now you have to take on personally, right? And the rate of that tax now depends on where you're a tax resident of. Yes.
So if you don't become a tax resident in any country, so you don't spend more than 90 days in the UK, you don't spend more than 183 days in Sweden, etc., then you just don't pay taxes anywhere.
That's what I do.
So we'll get into that.
You just
okay?
be in Georgia.
We'll get into that tax resident of nowhere, right? Maher is asking, what if I'm not in any tax system, right? What if I'm not in the UK system, in the Swedish system, I'm just not in any system at all, right? To the natural extreme, if you're spending 52 weeks traveling in 52 different countries, then obviously you're not spending enough time in any single country, right? In any single country to be able to qualify for tax residency, right? But the problem is, it goes back all the way to what every single country considers tax resident, right? So in Thailand, in the UK, it's like days. If you don't spend any days there, you can have your passport, you can have a car, you can have 5 houses, but they won't tax you, right? But when it comes to all those European countries, right? Italy, Australia's not Europe, but you know, Australia, France, Germany, all these countries here, if you're spending 52 weeks in 52 different countries, but you have a French passport, if you have a German passport, they will want to tax you, okay? And again, it goes back to the whole thing of, if you're making little money, they're not gonna care. If you make a lot of money, that's when you need to make your case strong, because maybe you get away with it, right? But maybe if, you know, your face is everywhere and you're making 15 million, they're gonna want a piece of the pie. They're gonna want to check on you. The bigger you are, the more, you know, attention you attract. Yes.
So the US doesn't have corporate tax.
That's correct.
In the
You can ask and make a request for them to pay corporation tax, but generally it doesn't. No.
Why would you do that?
Well, Tesla, Elon Musk doesn't want to pay all the profits for Tesla, right? The bigger the company, usually, the more you're likely to want to have corporation tax, right? You then have different companies in the US, S Corp, C Corp, I mean, it doesn't matter. But yes, the US company, as a standard, does not pay any corporation tax. Yeah, does that make sense? Okay, so this is a different payout structure, and this is how we can exploit it, right? This is how a lot of how it's done the right way. So the profits go through the company, right? The company now pays 0% corporation tax. Actually, to be precise, it doesn't pay any corporation tax. The profits now flow down straight to you, and now you have to pay tax personally based on where you're a tax resident of, right? If you're a tax resident in the UK, UK taxes. If you're a tax resident in Thailand, Thai taxes, right? But Thailand only taxes you on the money you bring inside of Thailand. So as long as you keep it outside of Thailand, Thailand doesn't tax you, right? So now, £1,000 come in, you don't pay any corporation tax. You then withdraw £1,000 and you don't pay any income tax because you don't bring it into Thailand, right? Does this make sense?
What do you mean with bring it into Thailand? So if I go and spend my money here in Thailand, is it in Thailand or outside of Thailand?
That's a great question. Okay, so the main way of bringing money into Thailand is sending it to a Thai bank account. Like that's just the easiest way, right? If I'm sending money into a Thai bank account, that's brought inside of Thailand. Technically, if you're spending money in Thailand, right, that's income that it's brought in. But then again, it's a gray area because like, how do I know if it's money I had from before becoming a tax resident, or if it's money that he's actually earned this year and is now bringing in, right? Is now bringing into Thailand. Does that make sense? So I'll give you an example. Let's say you have 10K if you're in your home account, right? Now this year you make another 10K, and now the personal bank account has a 20K, right? It's outside of Thailand. Now when you're spending that money in Thailand, who are they, like, how are they gonna tell if you're spending the money that was there already, because you're allowed to bring money from before, and that's not taxed. But if it's money that you've actually earned, if it's income, then that is taxed, yeah? So technically, yes, that's money brought into Thailand, but in practice, Thailand has nowhere near the infrastructure. The infrastructure in Thailand is nowhere as good enough to be able to detect that stuff. So realistically, because then you can, like, we'll see it later, but you can just use your card to pay for business stuff, right? And use them as business expenses. If you go out for dinner, you can say it's a client expense. If you take a flight, that's a business trip,
right? For example. So then that's not income, that's like a business expense, so that's not taxed, right?
So you gave the example of you transferring the money from the business account to your personal account.
Yeah.
Why would you even have to?
Well, because, okay, that's a good question. So normal accounting, you're not supposed to use your company's card to pay for personal stuff, right? And that's just normal, because again, the company's a separate entity, and obviously as long as it's you, it's stuff that it's all right. Like we'll see that the reason why you can do that is because the US doesn't share information with other countries. So the only country that can really argue against an expense and say, hey, this is actually not a business expense is the US, right? Because they are the only one that have the information. But they have no incentive in saying that because they don't tax you anyways, right? So you open a company, but it doesn't pay any tax, right? So they're fine with you spending all the money in the world. But if you wanted to do it properly, if you wanted to buy stuff in your personal name, we'll see the limitations. You're going to have to transfer it in your personal account, because like one of the risks of buying assets now with your company stuff is like, where does this money come from? You know, they're going to ask like questions like where, like about money laundering and all this stuff. Is this structure clear? Yeah.
Yeah.
So what are the limits of the LLC? Money laundering risk, which we'll go over later, and then it can impact the tax residency judgment. So again, a common theme in this thing is the more money you make, the more attention you attract, and the more you need to make your case solid, right? If you're making all this money from the LLC and you're moving it into a personal account, like, I don't know, I don't want to use the UK because they've got a days test, but let's say Ireland, for example. If you're making all this money from the LLC and you've got your tax residency in Thailand, you know, you've set up in Thailand, it's all good. But now you're sending $500,000 a year into an Irish bank account. Ireland might go, hey, what the fuck? I thought you said you're living in Thailand. Why is all this money coming into Ireland, right? Because the usage of a bank account in your home country is one of the factors that determine your tax residency, right? So again, the more money you make, the less money you want in your home country. You want to use banking solutions offshore. You want to reduce the time that you're spending in your home country. And the reason why the LLC can impact the tax residency judgment is because it's such a gray area. Like the money that you're taking out of the company is not actually dividends, right? It's not a salary that you're taking out from this LLC, right? It's just income, right? It's just money that's yours. So they could argue that that income is generated in Ireland, Sweden, you know, whatever. Again, at a very high level, when you're making a lot of money, that's when this structure becomes a bit weak. You know, over $1 million, let's say, it becomes a bit weak. It's nice to have this corporation tax barrier right in between that protects you and separates you from the business from a tax point of view as well. Right? What do we have to? Why it's harder to hide your money? So this is, I think Finn, you were talking about this. Why it's harder to hide your money and how you can still do it. So here's your Swedish tax residence, right, with his Swedish bank account. But now he's like, goes to Thailand and he wants to open a bank account in Thailand. He's making a lot of money and he's like, okay, if I put all my money into Thailand, most of my money into Thailand, and only a little bit into Sweden, now I can hide all this money and only say that I earn this much to Sweden, right? So the reason why this doesn't work is because there's an agreement between most countries in the world where now Thailand has to go and share that information with the Swedish tax agency, right? So, and this works for any country, like this could be UK, this could be US, this could be Italy, whatever, right? Because when you open a Thai bank account, they ask you, hey, where are you paying your taxes? Like, where are you personally tax resident, right? And now, what happens is Thailand, even though you've parked all that money in a company that's offshore, now the Thai bank account, the Thai bank has to go and tell that to the Swedish tax agency. So now Sweden still has the whole information, right? How do you still do it? There are a few countries that still haven't joined this program, such as Vietnam, Bolivia, Armenia, some of these crappy countries where you don't really have good banking solutions. That's what I wanted to say, right? Not developed. But here's the catch. the US is probably the most advanced country that doesn't share information, and it's the reason why a lot of you fuckers are going to be able to get away with doing dodgy stuff with your US LLC. If you have a company in the US, if you have bank accounts in the US does not share that information with anyone, right? And that's the reason why you can go out and spend money however you want. Obviously, it's not something I recommend, but you know, a client dinner, an international travel, you know, it's something that you can pass off quite easily. Is that clear?
Yeah.
Yes.
So Sweden would never know how much I'm making.
No. So the problem happens when you move that money from the US company to your personal accounts. You're saying, why would I want to move my money from the US? To buy assets. As long as you make $1 million, spend $1 million, you just ball out, because you know we don't really save money, we just make money and rent out expensive villas, right?
Yeah, that's what we do.
But no, what happens when you want to buy assets, right? What happens when you want to buy a car, a house, when you want to invest? And this is where the money laundering risk that I was talking about comes into place. You're making all this money into this, it's going into this US company, but now you want to buy stuff, right? Now you want to buy a house, right? You can't just buy the house from your company, because now they're going to ask you for proof of funds, right? They're going to ask you, where's this money coming from? And well, I guess it doesn't matter whether you transfer it to your UK, like to your personal bank account or from the company, but regardless of that, they're going to ask you where that money comes from, right? If you send it to the account, or if it's still in there, like if you use it to pay for something big, they're going to do AML checks, anti-money laundering, right? And before even questioning tax evasion, like why is all this money coming here, they're going to be asking, where does this money come from, right? Because like, make $1 million, spend $1 million from your US bank account, no one knows anything, right? But what happens when you want to buy assets? You know, are you going to own a house at some point? Are you going to own some stocks at some point, right? I assume you are, right? And this is where, when you're making, this is my personal rule, when you're starting to transfer over $500,000 a year into your personal bank accounts, that's when you want to set up a structure above it. You know, we're getting a bit more complicated, but I think this LLC works up to $500,000 just on its own, right? Go ahead.
Why does not buy the car from your bank account, like the business one?
Again, it depends. If you buy it in Thailand, they only care about the fact that you're paying you. But for other countries, they'll ask you where their money's coming from. You know, they won't accept the card that's not your personal card.
I would be like, I have a business in the US and I'm making money.
Yeah, but they're going to ask you, okay, where does this money come from? And again, it's legal, right? We're all business owners, so it's fine. But this just means that you're going to have to show your receipts, right? Show that your business is an actual real business. You know, there's all these companies in Delaware, Wyoming that are famous for all this money laundering stuff. Yeah, you guys watching this? But yeah, it's important to keep your receipts, because a lot of you guys, you might have a company and you're just getting sent the money, right? And that's a problem, because you don't keep your receipts. And again, as long as it's 50K, 100K, like it doesn't matter, right? But once you're making like over $1 million a year, I'm sure like everyone here is gonna get there at some point, right? You need to keep your receipts, because if you've got $1 million in your bank account, right, and you don't have proof, that you're actually, you know, you've made that money in a legit way, like with invoices, with proper invoices, then you're not going to be able to use them. They're going to freeze your accounts. Like, realistically, if you send a 20K transfer, I don't know, 20K, maybe a bit higher, but if you send a 20K transfer from your LLC to your UK bank account, I guarantee they will ask you questions. They will freeze the account and ask you, where does this money come from, right? Because there's no automatic exchange of information. They can't see what's going on here, so they have to ask you questions. So like, what if this guy sold drugs? Right? They don't know. The US doesn't care. I have a company in the US. They don't care what I do in the US. But because my home country can't see it, they're always very careful with, you know, being able to spend money and use money when the money comes from somewhere like that. Which is why it's important to keep your receipts. If you're using Stripe, those are automatic. Like, you're going to have them on the record in Stripe. But if you're not, if you're just getting bank transfers, make sure to issue receipts. Even if they're just like, just Word, right? You're doing it on Word, or just get a shitty template. But make sure you've got receipts, because that's going to be super important. Yes, Scott.
Okay, so if the U.S., if you don't have to pay taxes through your LLC, then what's the incentive of U.S. allowing foreigners to make bank accounts there, aside from like the like $300, $600 fee to actually get it created? Like what? There must be some way they're making more money off this, right?
That's a great question, and I'm not sure I have a very good answer, but it's mostly going to be to allow trade in the US, right? So if you want to do business in the US, you're going to bring money to that economy. So I know Dan was talking about starting, actually no, he's got an e-com business, he's going to sell into the US, right? An LLC is probably going to be the best company for him to sell in the US, right? A US company to sell in the US, right?
So is it something then like it just strengthens the USD?
I guess so, yeah.
Okay.
Again, I don't have a very good answer to this, but it definitely does, right?
Uh-huh.
You're incentivizing people to use the dollar, 100%. If you actually have people in the US, you actually will have to pay corporation tax, right? So like as a foreigner, you don't pay any tax as long as you don't have like operations in the US. So you can sell in the US, but you can't have like employees, offices and all this stuff. So that's a great question. They might take it off because, you know, it's true. It doesn't really have a lot of tangible benefits to the US that I know at least, unless, aside from facilitating trade in the US.
Okay.
Right? Is that clear? Okay, beyond the tax rate. So obviously we're always talking about tax rate, 15%, 20%, 0%, blah, blah, blah. But there's a few other things you need to consider when deciding where to set up. And the first thing is banking, right? Banking, it's like you can set up in Paraguay. Maybe a few of you have heard of Paraguay. It's got a territorial tax system. They don't tax you in Paraguay. But banks are shocking, right? So what's the point of setting up in Paraguay if you can't use their banks? Sure, you can use your home country's bank, but then again we go back to let's strengthen the case that we're actually using a bank in the country where we live, right? Paraguay is not really a solid residency for most countries because sure you can get your residency in 2 months, but you're not actually living there. If they actually come and check and ask you, hey, where are you paying taxes? Like, where's your tax residency? And you say Paraguay, they're like, wait, but you've got no money in Paraguay. You're spending like 3 days a year in Paraguay. This is not where you live. And this is where the tax residency and civil residency concepts overlap, right? So Paraguay can work, right, for certain people. Mostly those days countries, right, like the UK, for example. Again, as long as you're out in the UK, you can do whatever you want with, you know, your time. But for other countries, like again, Italy, the European countries, Australia, blah, 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 you actually need to show them that you're living somewhere. And again, making little money, no one's gonna care. The more money you make, the more you're likely to get checked. So banking, and alongside that, payment processing, Stripe, I don't know if a few of you have had problems with Stripe. It can be an absolute nightmare depending on where you live. They might not even open your accounts. Haven't used WAP, but I assume it's going to be the same. You're going to be careful to open accounts from countries that are a bit dodgy. Geopolitical risk. Few people want to open up companies in Hong Kong. You know what happens? China takes over. You know, it's very remote opportunity, very remote likelihood of happening, but you know it can happen. Do I actually want to set up my company in Hong Kong? And right now, to be fair, this could be said of the US as well. Do I want to set up my company in the US? You know, what happens? Maybe something changes. Maybe they start to tax us. Same for the personal residency. Like, where do I want to live? Do I want to go somewhere where, you know, it's unsafe? No, I don't. Initial capital requirements. You're like, yeah, I want to take all my money to Switzerland. Costs 100K of initial capital to open a company in Switzerland. It costs, you know, $1 million to buy a property in Monaco, at least to get your residency. You're like, I'll just buy a property in Monaco. To get private banking in Hong Kong, for example, these offshore banks, you just need a lot of money. So that's something you need to be careful about. In Cyprus, a lot of people want to stay in Europe and set up in Cyprus. Legal fees go up to like 10K just to set up your company in Cyprus, and this is not even, you know, the fee of like a tax advisor or anything. You know, just the local accountants. That's what they're going to ask to open a company in Cyprus, right, or in Malta. And finally, it's like, where do you actually want to live? Like, think about it. And I know it's like really hard for us as online entrepreneurs and digital nomads. We go to Koh Samui and we love it, but maybe we miss the city, so we go to the city and then we miss our parents and we want to go back. Maybe you go to Colombia, we meet a girl and we go, maybe I want to settle down in Colombia. So try and actually have a thought, where do you actually want to live when deciding where should I set up and where should I pay my taxes, because that's actually the most important thing. And right now maybe you don't have a tax residency, or you're still your home country, or it's a gray area. That's fine at the moment, but as you grow you're going to want to set up in some place, and yeah, that's the main question you're going to have to ask, where do you actually want to live. Just finally, a few FAQs, stuff that you might be wondering or it's important for you to know. Wise, Revolut, they operate exactly as normal banks, right? When you sign up to Wise, when you sign up to Revolut, they're going to ask you for your tax details, right? So if you're from the US, they're going to ask you for your social security number. If you're from the UK, they're going to ask you for your national insurance number. If you're from Italy, they're going to ask you for your tax code in Italy. So basically, this acts as a bank of whichever country you're a tax resident of. This means that information is still shared to the tax offices, right? So if you're Italian, that information is going to go to Italy, right? Of how much you've got in that Revolut or in that Wise. Number two, crypto. Crypto's taxed exactly as stocks in capital gains. You pay tax when you sell it. Something that you might not know, which is actually very annoying, is that even when you swap from Bitcoin to Ethereum, from shitcoin to USDT, from shitcoin to shitcoin, those are technically taxable transactions, right? Taxable events. Again, very hard to manage if they're on cold wallets, or if they're off chain, if they're not on exchange. But just so you know, usually when you change crypto to crypto, you still have to pay taxes. Not just when you withdraw it, but also when you exchange them. Yes?
Can I ask a question? Where's the... So with the crypto transactions, I know a lot of the exchanges, they don't necessarily report, like Coinbase, are they reporting to federal
Coinbase
tax?
is reporting. So Coinbase, Binance, Kraken, all these platforms operate in the exact same way as Wise and Revolut. When you sign up, they're going to ask you where you pay taxes. It used to not be like that. I think KuCoin was a non-KYC. It's know your customer, where basically don't even ask for your name, your surname, your information, and your tax information. But now, they've been pressured by countries. Basically, they're asking you. If you sign up for Coinbase, they're asking you for your national insurance number, right? And that information is getting reported to the UK. So HMRC will know. The only way to for them to not know if it's off chain, if it is off chain, right? Does that make sense? Lovely. And can I be a tax resident of nowhere, right? So that's the big question. And again, it's a big gray area. If you're if you've got a passport from one of the countries where it's only days, less than 90 days, less than 180 days, less than 183 days, yes, you can. Again, not ideal, because then they can still come after you for some stuff, but again, very high level. If you're a resident of one of those countries where the concept of residency and tax residency overlap, right? And one of those countries where you're a tax resident if your usual home is there, then you really can't, right? The threshold for that is very, very low. And it's just best to not be. And maybe they don't come after you. If you've got a US company, the US doesn't really know it anyways, that you've got money, but it's long term, it's better to not do that. And social security, NHS. Once you actually deregister from your country, from your home country, and move to a different country, you're gonna lose this status.
Cool.
Obviously, if you're dying, right, they're gonna call an ambulance, they're gonna treat you and stuff. But for operations, surgeries and stuff, if you're not tax resident there and you're not paying taxes anymore, you're gonna have to cover those expenses on your own. So I recommend you get health insurance, right, in the country where you're resident. Here in Thailand, the hospitals are great, but they are expensive. They charge a lot of money because they assume tourists have insurance, which you should do probably if you're not a tax resident back home. And this is it. Any questions?
You have the mic?
So
you set up your company in the US and then decide you didn't want to like live there long term, wanted to change your country, like your company, like what would that look like?
If you want to, so okay, can you repeat the
If
question?
you wanted to like, say you set up your company in one country and then you wanted to change the country of which the company was in, like, what would that look like?
So, as online entrepreneurs, we just close it down and just open a new one, right? And you tell your mates, like, hey, now I want to get paid in this other place, or you just change your Stripe link, create a new Stripe account, and you get paid there instead. Obviously, if you have employees, it's a bit different. Like, Tesla can't really decide to shut down a company and set up a new one, somewhere else. But for you, it's actually, it would actually be very easy. You just close it. In your next tax return, you say, right, this is my final tax return. I'm closing the company, and then you just set up somewhere else, and that's company level. Yeah. Any other questions? Okay. Yeah. I guess that's it. Thank you for watching. Yeah.
I've got one. It's about the NHS thing.
Yeah.
So it's about the NHS thing.
Yes.
Are you not covered by the NHS then, since you're not a tax return in the UK? Do you have private healthcare or just health insurance?
Private health insurance. Yeah. Health insurance.
Health insurance. Right. I'm going to put that on the to-do list tonight.
Sorry?
I'll put that on the to-do list tonight.
There you go.
So, kind of reeling things back into your specific service delivery, I'd love to hear some more about that. Like, what does it look like? I know it doesn't really apply to me, but for the rest of the lot, what does it look like working with you?
So I help online entrepreneurs legally reduce their taxes and move from their Western country into Southeast Asia. The idea is that there's all these like young 20-year-old people, very young, very ambitious, very good at what they do, they're making loads of money, but they have no idea how taxes work, right? So a lot of times they're either still paying 45% back home to their home country, or they're just not paying taxes at all and committing tax evasion, both of which are really bad and both of which help to solve with the 3-step process. Get out of your home country, get in the new country, income tax, tax residency, and then set up a company offshore.
Awesome.
Any other questions?
Leo, that was incredibly valuable. For the people watching on YouTube, where can they find you for tax help?
Right here. Instagram, Leonardo_Vincenti. Thank you for watching.